My name is Avira Joseph. I am the founder of Blivos Academy. At Blivos Academy, we ensure we provide financial education and financial empowerment. Now, the reason why we do this is because we know we don't come into financial prosperity, sustainable financial prosperity, without education. So the aim of Blivos Academy is to provide financial education and also the financial empowerment. So we educate you, we tell you how to make money, we also give you money to multiply. Currently, we are giving our students and subscribers $100 to trade forex market, and the condition for that $100 is if you make profit on the account, you can withdraw. But the disclaimer is no matter the profit you make, you can only withdraw $100. Secondly, before you make withdrawals, you can only trade, not you can only, you have to trade 30 lots before you can make withdrawals. Then thirdly, another disclaimer is Blivos Academy is partnering with the company to provide the $100. So the company we are partnering with can withdraw their $100 at any time, and Blivos Academy is also setting themselves free from any form of liability in the future. If you're okay with that, we can proceed. I want to talk about the things you have to look out for before you buy the shares of any company. So the first thing you have to look out for before you buy the shares of any company is the company's revenue. Now, the revenue of the company you want to buy their shares must be growing consistently for the past 5 years. The revenue of the company you want to buy their shares must be growing consistently for the past 5 years. The next thing you have to look out for before you buy the shares of any company is the company's profit. The profit of this company you want to buy their shares must be growing consistently for the past 5 years. Now, profit can also be called net income. That is, profit after tax is net income. So the profit must also be growing consistently for the past 5 years. The third thing you have to consider before you buy the shares of any company is the company's cash flow from operating activities. Now, cash flow from operating activities is the money that a business brings from doing business activities like sales and manufacturing. So if money comes in, cash comes into a company, real cash, because of sales and because of manufacturing, that is cash flow from operating activities. The next important thing you have to consider before you buy the shares of any company is the company's economic moat or sustainable economic advantage. So we want to look out for the company's economic moat. And what is economic moat? Economic moat is what a company has now that is making them relevant now and will also make them relevant in the future. So economic moat is what a company has now that is making them relevant now and also make them relevant in the future. So how do we find that? How do we find economic moat? The first way to find economic moat is to first identify the industry of the company you want to buy their shares. So let's say you want to buy the share. Which company should we buy their shares? Which company is what buying their shares? Okay, let's say Tesla. Tesla Incorporated. Want to buy the shares of Tesla Incorporated? So the first thing we'll look for is the industry of Tesla. After we look for the industry of Tesla, we'll move on to looking for other companies that are in that industry. When we do that, we're going to move on to identifying the revenue, the profit, the cash flow for operating activities for all these companies in that industry. Then the next thing we want to look for is who is the king of that industry. So the company that has the greatest number in terms of revenue for the past 5 years, profit for the past 5 years, cash flow for operating activities for the past 5 years, and customer base is the king of that particular industry. So we want to know whether this company that is the king of that particular industry will still remain the king in the next 10, 15 to 20 years. So how do we do that? We do that by knowing the current technological innovation this company is working on. That is what's going to keep them relevant in the near future. So if you've gotten that, we're going to move on over to the next year to look out for before you buy the shares of any company. And that is what I call current ratio. Current ratio is current assets divided by current liabilities. It helps investors to know whether a company will be able to pay their short-term debt. So if the value is less than 1, it means the company you want to buy their shares will not be able to pay their short-term debt. But if the value is equals to 1 or greater than 1, it means this company will be able to pay their short-term debt so you can buy their shares. If you're okay with that, you've gotten into that point, we move over to the next thing to look out for before you buy the shares of any company. And that is what I call returns on equity. Yes. So the returns on equity for the company you want to buy their shares should not be less than 10%. That's our benchmark. So, and returns on equity is net income divided by shareholders' equity. So, times 100 over 1. So, the returns on equity for the company you want to buy their shares should not be less than 10%. So, the net income divided by shareholders' equity multiplied by 100 over 1 should not be less than 10%. The seventh and the most important thing you have to look out for before you buy the shares of any company is the company's intrinsic value. Intrinsic value, that is the real share price. And if the intrinsic value is greater than what is quoted in the stocks market, it means this company is overvalued, is undervalued. That is the right time to buy the shares of a company. But if the intrinsic value is less than what is quoted in the stocks market, it means the company is overvalued. You can avoid them. So the reason why we have to do this is because a good company can be a bad investment if you're buying the company shares at the wrong time. So the reason we have to know whether a company is overvalued or undervalued is because a good company can be a bad investment if you're buying at the wrong time. The wrong time is when it is overvalued. So the important question to ask here is, what is a good company? So a good company is a company that has consistent growing revenue for the past 5 years, consistent growing profit for the past 5 years, consistent growing cash flow for operating activities for the past 5 years, a strong economic moat. The returns on equity is not less than 10%. The current ratio is not less than 1. So these are the qualities of a good company. So when you say a good company, you're going to look for calculating the intrinsic value of this particular company. So for our premium students, we give them an intrinsic value calculator to calculate the share price, the real share price of this company. So if you've gotten that, we are going to move over to how to do this practical example. So the web application we are going to use to find the financial statement of Tesla is going to be investing.com, and we are going to use our own intrinsic value calculator for Bluehost Academy to calculate the intrinsic value of Tesla to know whether it is overvalued or undervalued, whether it's the right time to buy or we should avoid them. So click on my browser. I'm going to type investing, okay, investing.com, and I'll press go. Okay, it just loaded. It's loading. Close out of this app. Now to the top right is a search bar, a search icon. You click on it. The company you want to research on is Tesla. Tesla Incorporated has come out. You click on the first search link. Tesla Incorporated, it says stocks, Nasdaq. I think I just click on it. It's not responding. Okay. Let's allow it to load. Sometimes investing.com has some score challenge. By score challenge, I mean technical challenge. This is another challenge hovering over us here. I don't think this is network challenge. Could it be? Okay, let me refresh. It's not refreshing. What's going on? Just having a free screen. Let me go back. Okay. Okay, Tesla Incorporated. The share price of Tesla is 459.46. $459.46. That is the share price of Tesla as of today. And what we want to look for is the financials, the revenue, the profit, the cash flow for operating activities, the current ratio, returns on equity, and intrinsic value. So now that it has opened, we'll click on this place that says financials, and we'll allow it to do its stuff. Okay, it has loaded. Okay, close out from this app that's popping up here. So we are looking for the financials of Tesla. And we're looking for, first we are looking for the revenue. I told that the revenue must be growing consistently for the past 5 years. So this is revenue here, just highlighted. And the year 2020. Now we'll scroll down, say all in millions of USD. So every number here, you multiply it by 1 million. So for 2020, the revenue of Tesla was 31 billion. 2021 was 53 billion. 2022, 81 billion. 2023, 96 billion. 2024, 97 billion. So you can see it has been growing consistently for the past 5 years. So Tesla has a 5/5 score. Consistent growth in revenue for the past 5 years. We'll go to net income, that is profit. We'll highlight profit. For 2020, it was 72 times 1 million, that is 720 million. 2021, it was $5.5 billion. 2022, it was $12.5 billion. 2023, $14.997 billion. 2024, it dropped to $7.091 billion. So they've had a 4 years of consistent growing profits in 5-year period. The next we want to look for is the cash flow from operating activities. Cash flow from operating activities. Some web application, some analysis website calls it cash from operations. So look at it here, highlighted. Let me highlight it again. Cash from operations. So let me scroll down to 2021. For 2020, their cash flow from operating activities was $5.9 billion. 2021, $11.49 billion. 2022, $14.924 billion. Wow. 2023, it dropped to $13.25 billion. 2024, it now moved to $14.923 billion. So they've had 4 years of consistent growing cash flow from operating activities in the past 5 years. That's quite impressive. So let's go back to looking for their current ratio and returns on equity. So still under the financial tab, you can see it's tab blue. Financial summary is still open. What you're going to look for is ratios. So we'll click on ratios. Okay, that's open. We're looking for the current ratio. Now the current ratio, not current returns on equity first. It's under management effectiveness. Sorry, let me go back. It's under, where's my management effectiveness? Yes, management effectiveness. Look at it here. The returns on equity to the right of it is 8.18, so it's less than 10. It has not met our benchmark. So the next thing we want to look for is current ratio. Current ratio is under financial strength. Look at it here. To the right of it is 1.36. So yes, this one has met our benchmark. So the only point that Tesla failed in becoming a good company is their returns on equity. They have a 8.18% returns on equity. So it's still forgivable. It's not a sin unto death. It's not an unpardonable sin. So now we have discovered that Tesla is a good company. We want to know whether Tesla as it stands is at the right price. So this $459, $459 46 cents, is this the right price? If we buy now, is it going to keep going up or is it going to fall down? So that's the reason we have to check the real price. So we use our calculator, and I'm not going to give you everything about this calculator, but I'm going to show you how to use it. Okay, so the calculator is open. We are going to put the name of the company here, Tesla Incorporated. The next important information for this calculator is the free cash flow. So we'll go back to our investing.com. We'll look for the free cash flow. So how do we look for that? Still under financial tab, you click on financial summary. We'll allow it to load. Okay, that's loaded. We'll scroll down to the page that say cash flow. Under cash flow, you can see levered free cash flow. Levered free cash flow. So they had a negative free cash flow. Negative free cash flow is a red flag. But let's just impute it. A negative free cash flow is a red flag. But that negative free cash flow is, let's go back. It's a terrible red flag. 826.88 minus 826. That means that year, 2024, they were losing money. Negative free cash flow. So minus 826 million, 826 million. Minus 826. 1, 2, 3, 4, 5, 6. So what we are looking for here is returns on equity. We're going to put 8.18. Remember, that was the returns on equity for Tesla. Period. The mathematical formula, the method we are using to calculate the intrinsic value of a stock is the discounted cash flow method. And in the discounted cash flow method, what we seek to do is to know the worth of a company in the future. So that future is this period. The worth of a company in the future. And that future is period, and that future should not be less than 10 years. In the future, what will be the worth of this company based on their free cash flow? So we are already having a negative free cash flow. So any calculation you're getting, you'll be getting a negative value. So let's say 10 years, if Tesla keep having a negative free cash flow, what will be the worth of their company? And when we get the worth of their company in the future, we're going to divide it by the outstanding shares to get the real share price. So let Tesla, what's Tesla outstanding shares? Tesla outstanding shares, let's go back to our investing.com. So what we are looking for is the outstanding shares for Tesla. So you're going to click on general. Outstanding shares of Tesla. So we will click on general. We're going to click on ownership. Under general, you click on ownership. Okay, it has loaded. Now you scroll down. You can see common stock held. Under, you can see total. To the right of it is 3.3 3.33 billion. 3.33 billion is the outstanding shares of Tesla. Outstanding shares is greater than free cash flow. It's a very terrible red flag. So let us put at 3.333. 1, 2, 3, 4, 5, 6. Share price so share price is for Tesla is 459.46. So let's go back to our calculator. $459.46. So click on calculate. Wow. The intrinsic value of Tesla is minus $16, and it is 2,882%, in fact 2,883% undervalued. Wait. Undervalued. So why it's showing undervalued is because the outstanding shares, not outstanding shares, the free cash flow is already negative. So the intrinsic value is going to be negative, and the intrinsic value of a company cannot be negative. A company starts if a company falls, loses all its value, is going to stop at 0. So intrinsic value of Tesla is showing minus 16. So it is because of the free cash flow that was negative that is giving us a negative value of minus 16. So Tesla is a company you should just avoid them. Avoid them for now. So because it is minus 16, that's why it is showing 2,883% undervalued. So Tesla is not a company to buy their shares because the intrinsic value is minus 16 based on their free cash flow. The intrinsic value is minus 16, and intrinsic value of a company cannot be minus 16 because if a company loses all its money, their share price is going to be 0. So it cannot be minus. So Tesla is a company you have to avoid now. Avoid them for now. So my name is Avira Joseph. This is how I teach individuals to identify good companies in the stocks market, make profit for them, and we prosper together to sponsor the work of God. Take charge.